welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy. Today we'll be reviewing what's happened in the markets through July and also with our portfolios and kind of give some color on where the economy stands and thoughts of how we want to address things moving forward. So Cameron, why don't you kick us off with an economic update?
Thank you, Kelly. Good morning, everybody. Biggest news we've had thus far from an economic standpoint would be the July jobs report that just came out August 6th. This is according to the Bureau of Labor Statistics. Total non-farm payroll employment rose by 943,000 in July, and the unemployment rate declined to 5.4%. Notable job gains occurred in leisure and hospitality, in local government education, and in professional and business services. Now, the consensus estimate for jobs was 845,000, so have roughly 100,000 job beat. We're looking at a 5.4% unemployment rate, which is, if you look historically since the Great Depression, that's kind of in line with the average. So it kind of begs the question of how many more jobs can you add when you hit the average? But then, interestingly, the Department of Labor reported last week that total unfilled jobs in the U.S. are 10.1 million, and that number increased by 500,000 last week. So I don't think this is lost on anybody. Leisure and hospitality, production employees, hourly employees. I mean, I know when you drive around the city of Cleveland right now, it seems like every little manufacturing company has a sign out front. Now hiring, walk-ins accepted, sign-on bonus, $14, $16 an hour. I mean, there is 10.1 million jobs is a significant number of unfilled positions, a lot of it in hospitality, retail, and on the hourly production manufacturing side. That really begs the question, if we're at 5.4% unemployment right now, and we have 10.1 million unfilled jobs, we could be looking at a jobless rate under 4% again.
Kind of right where we were pre-pandemic,
yeah.
And that's what a lot of the economic numbers are showing us, is we're back to where we were. Mm-hmm. Maybe, some of the numbers are coming in ahead, some numbers are slightly less, but you could argue that the economy's not fully reopened. We're getting there. We have the threats of another shutdown, or certain localities having shutdowns because of the Delta variant. And that what also ties into, where we know some of the weaknesses are because of supply chain constraints. Where are we really at in the grand scheme of things? And, is this a true expansion or just a recovery from the COVID crisis is kind of where we stand now. Why don't you continue on with
as of right now, it looks like we are in an expansion. The Atlanta Fed's GDP Now forecast model, this is for the third quarter. As of August 6th, the forecast for the third quarter was a 6% annualized increase in GDP. The consensus Wall Street estimates range between 5 and 9%. So if you look at the first quarter, we were at 6.3% GDP growth. Second quarter, we were at 6.5%. Third quarter, we're looking around 6%. So, you annualize that at the end of the fourth quarter, unless there's been some major disruption, we're probably looking at a 6% GDP growth, which is, roughly 3 times what we're seeing on average. That really rolls into GDP expectations in the future. The Conference Board, which is a nonprofit research organization, global research organization, made up of over 1,000 public and private corporations as their members, they're projecting U.S. GDP to be 6.6% in 2021, 3.8% in 2022, and 2.5% in 2023. So really, after this year, we're gonna, the Conference Board at least is seeing us getting back to kind of just a normal economy, a 2 to 3% economy, which on $21 trillion of GDP, that's still a big number that we're adding each year.
Absolutely.
Yeah. Last thing that I want to talk about, we've talked about inflation the last several months. There are clear signs that inflation's out there. I want to quote some numbers. This is the Personal Consumption Expenditure Price Index. This is the change from a year ago. In February of this year, we had a 1.6% increase in personal consumption expenditure prices. March, it was a 2.5% increase. April, the 3.6% increase, May, a 4% increase, June, a 4% increase. So obviously, that's telling us that prices are going up, which means inflation's here. But what's interesting as a counter to that if you look at the 10-year Treasury, which a lot of people use to, as the benchmark for yield, 10-year Treasury hit 1.73% in March and is at 1.3 today. Obviously, Treasury rates are controlled by a reverse auction that the U.S. government runs. So when there's more demand, rates come down. So it just, it asks the question, we're seeing inflation, but we're not seeing it in Treasury rates. The demand for U.S. securities, U.S. fixed income, government bonds, obviously primarily being driven by the U.S. being a safe haven.
Well,
and there being no yield.
Right. You have two things going on from a buying standpoint. The Fed's still buying 70 to 80% of all Treasury bonds. Then you also have just not in the U.S., but throughout the world, a lot of money that has been created by the central banks that has to go somewhere. Mm-hmm. Even though several industries were deeply impacted by the COVID and by the pandemic, the reality is there's also a lot of industries that are making a lot of money. So when you get in a situation where the outlook maybe is a little questionable, money has to be parked somewhere, and that's driving demand for treasuries. That's
the U.S. government bonds have always been the safest of safe havens.
So I think we kind of get some mixed signals. You have the supply-demand dynamic of the treasury market and the bond market in general, because beyond treasuries, even high-grade corporate bonds and lower-grade corporate bonds, all interest rates have been suppressed because there's so much demand out there. There's so much liquidity floating around that it has to be parked somewhere. So you have the supply-demand dynamics opposed to maybe the outlook or the forecasting ability of interest rates, which is a little skewed. 10-year up to 1.3. Within the last couple of weeks, it was as low as 1.15. So does that mean treasury rates are bottoming out and we're starting to see them escalate higher, which ties us back to the inflation scenario? Higher inflation should dictate higher interest rates. So from a forecasting standpoint, some people look at lower interest rates as, okay, the economy's not as good as it looks or is going to get worse because the interest rates aren't taking into account inflation. Mm-hmm. Or are the markets looking beyond the inflation to inflation is going to come, it's going to hurt everything, which is going to cause deflation. Like I said, a lot of cross currents and different signals that are being driven by the bond market and frankly by the equity market too. So we're in a very unique situation.
It harkens back to that Goldilocks scenario. Correct. The economy is, you have sectors that are doing very well, you have sectors that are weak, you have supply and demand issues, you've got interest rate issues, you've got a lot of money out there, you've got pent-up consumer demand, an inability to fill jobs. So we're in that situation where the U.S. economy appears to be doing very well. Underlying, there are many positives. There are also very negatives. So it's not too hot, not too cold. If you believe these conference board numbers, that would suggest, in their minds, no recession in the near term, but kind of a smooth, kind of down landing from where we've been with this accelerated GDP coming out of the pandemic.
We're definitely late cycle, or it feels like late cycle from a big picture macro standpoint. The one thing that I'm starting to read a little bit about, and that's the dynamic. We talked about inflation running fairly hot, so inflation's increasing. Then the question of inflation is it transitory, which is what the Fed is preaching, meaning, okay, prices are high now, but once supply chains come back on, prices will come back down. And we've seen that in lumber. But the other side of the inflation dynamic is wages. Once wages go up, they tend not to come back down. So what component of wages is driving the inflation number versus raw materials? That's a question mark. And the one situation the economy can find itself in is where you have inflation rising faster than growth. That's what they call stagflation. And once again, that's a dynamic that is hard to get out of, which typically, to stave off inflation, the Fed will increase rates at some point in time. First, they'll stop buying bonds, which should allow rates to rise, or at some point they may start increasing rates. And in the latest numbers from the Fed, looks like next year they'll probably cut back on the bond buying that the Fed does every month. And then after they stop buying bonds, the next step is for them to raise interest rates, which is, the latest I've read is 2023. So it looks like it's going to be a relatively slow transition over the next 18 months to where we start to see interest rates going up, driven by the Fed, versus just market forces driving interest rates up. But even if we get in the dynamic where the Fed stops doing bond buying, that should theoretically increase interest rates, which is good for savers. Obviously, when we look at portfolios, there's really no place to get interest without taking a decent amount of risk by buying high-risk bonds. So we're kind of left with, okay, where do we put money? Well, once again, it comes back to what we've been doing, and a lot of it's to combat inflation, is where can you go where your assets are going to grow even in an inflationary environment. So now you have to look at quality assets, whether that's owning hard assets, things that naturally appreciate with inflation, being commodities or real estate, or once again, you go to high quality companies where they have strong balance sheets and the businesses can adjust for inflation over time. That's really been the main focus. It's just hard to allocate a lot of money to bonds unless they're very short term with in positions that we're comfortable with. But you kind of need to hold cash in case we do see a dislocation in the market, which we've had a strong market. And we're due for a major or serious dislocation, whether that's a 5% pullback, 10% pullback. I think that's one of those is coming at some point over the next couple of months. It almost has to happen.
The stock market,
if not a major dislocation.
The stock market doesn't go up indefinitely. There has to be some pullbacks. I mean, this Goldilocks scenario reminds me a lot of 2008, where things were going well.
2008, you mean 1998?
No, 2008, right before the financial crisis.
Okay.
So there was a Goldilocks scenario in the late 90s. There was one in 2008. This kind of feels like it because we've basically been on, since the financial crisis, we've been in a bull market, over a decade-long bull market. And eventually the music has to stop. It doesn't have to be panic and, all this wealth wiped out, but it can be severe. We've got to expect it's going to be here. And, just plan for it properly, which is, being in fixed income, being in cash, being in good hard assets, and being in good quality companies.
It'll be impossible to time, and that's the reality, is you just have to be prepared, keep the seatbelt on, and be able to ride through any kind of downturn is really how we've been positioning portfolios on an individual basis, client by client. The comment Cam made about the market going straight up, let's talk about numbers from last month, because it sure seems like it goes up every month. Last month, the Dow Jones was up 1.25%. The S&P was up 2.27%. NASDAQ not quite as hot, up 1.16%. Where we did see some weakness was in small caps. The Russell 2000 down 3.65%. On the international front, the MSCI EAFE, which is the developed world, down, or actually up 0.7%, and the emerging markets took it on the chin pretty badly, down 7.04%. So in your more considered, more aggressive asset classes or stock categories, you're seeing money sticking towards your large caps. U.S. orientation is really what's happening right now. Year to date, the Dow's up 14.14, S&P up 17.02. So earlier in the year, the Dow was leading the way. The S&P's kind of caught up and is now exceeding the Dow Jones. The NASDAQ's still lagging, both of those up 13.85%. Russell, which had a great year last year, once again representing small caps, up 12.73%. International markets developed up 8.08%. Emerging markets slightly negative year to date. So, that's kind of the dynamic we're living in, where what that tells me is people are seeking the consistency and the really safety of more large U.S. companies is kind of how I read the indexes. For our portfolios, growth with income last month, which is our balanced portfolio, July up 1.71%, so pretty good month there for growth with income. Year to date, it's up 9.25%. Big gainers, Starbucks up 8.6% for the month. Nucor 8.43% for the month. Nike up 8.43% also. The big laggards, Microchip Technology down 4%. Our emerging market position down 2.88%. Which is a lot better than the average, and then NVIDIA down 2.52%. NVIDIA, Microchip, even though they're down this month, they're still up double digits for year to date.
Had pretty nice runs.
Yeah, once again, year to date, NVIDIA up 50%, Lennar, our home builder, up 39%. Our commodity fund, Pimco Commodities, up 28%. Cisco up 27%, CVS up 23%. Year to date, the laggards, once again, emerging markets leading the way on the downside, down 6.31%. Gold has really cannot gain any traction this year, even though commodities in general are doing well. Gold did well last year. This year, down 4.79%. Disney, year to date, down 2.85%, and then Verizon down 1.19%. So downside, not, and nobody really down huge for the year, but just kind of churning around. Obviously, when things are down, we have to reassess. Do we want to hold them, and what's the reason they're in the portfolio? So that's something we're always looking at. For our dividend yield portfolio, July, great July, up 3%. Year to date, we're up 19%. These are our high quality, high dividend yielding stocks. So, that's
this is supposed to be the boring boring portfolio.
This has happened in the past where all of a sudden the most boring, Widows from portfolio does the best. Yeah. Gainers in July, Blackstone up 19.38%, Pfizer up 10%, Paychex up 6.7%, Eaton Corp, a local company, up 6.67%. Laggards in July, UPS down almost 8%, down 7.99. Caterpillar down 4.48, Intel down 4.1. From a year-to-date standpoint, some of our winners this month, Blackstone up 83, Eaton up 33, Prudential up 32, Waste Management up 26.84. Big laggards, Merck down 4.39, British Tobacco down 1.9. British Tobacco down 1.9. That's our, that's not too bad. Merck only down 4 as our worst performers. Those are hanging in there pretty well. Price potential, more of our growth-oriented portfolio. Once again, a good July, up 3.15%. Year to date, we're up over 17. So price potential gaining some ground in the last couple of months, which is what we want to see happen. Big gainers, Perkin-Elmer. They're a medical measuring company or diagnostics company, up 18.07. Costco up 8.81. Edwards Life Science 8.4. Big laggards, Lockheed Martin down 1.77. Amgen down 0.91. Union Pacific down 0.53. So kind of flat for the laggards in July. Year to date, S&P Global up 30%. CBOE up 28%. Perkin-Elmer, once again, up 27%, Allstate up 20%. Insurance companies doing pretty well this year. Usually they're pretty boring, and we've held on to a lot of those for a while, finally making some money there. Once again, laggards aren't real large. Becton Dickinson down 5.3, then Fleet Corp down 0.5. So, price potential doing what it should be doing and making up some nice ground. In our small cap portfolio, July, we actually eked out a gain up 0.5% versus the index, which was down 7. So, I'm sorry. Yeah. Oh, I'm sorry. Index was down 3.6. We're up 0.5%, which is, I'm pretty happy with that. Year to date, we're up 16% in the small cap portfolio. Big gainers, Rapid7 up 20%, Perficient up 17.25, Patrick Industries up 13, National Healthcare up 11. On the downside, a little different than the other couple portfolios. July laggards, Par Technologies down 12.7. Radiant Logistics down 10, Eventbrite down 6. Year to date, here's some big numbers. Perficient up 97%, Atcor up 83%, LGI Homes, our other home builder in our portfolio, 61.45, Advanced Drainage Systems up 46. And then on the downside, year-to-date laggards not huge. Typically we see some bigger numbers here, unfortunately, but this month, or year-to-date, Pros Holding down 14%, Par Technologies down 2, even though we had a big month last month, and Allied Motion Technologies down 3.27. So in general, our portfolios are doing what they should be doing.
They're doing exactly what we preach.
We had a good month last month.
Yeah,
right.
High quality, taking advantage of the upside, but protecting against the downside. Unfortunately, where our portfolios really kind of stand out is when the market has, its stumbles and when there is a down market, because then you see the safety and the quality and the consistency of those high quality companies. With the market continuing to be on kind of a bull run, the portfolios do what they're supposed to do, but you don't really get to see them shine in those rough times.
Well, the raw numbers look good.
Yeah.
We may lag the index, but once again, it's my big concern now is what's coming down the pipe.
Yeah.
How is inflation going to affect us? Do we have enough momentum to actually get to stronger year-over-year growth beyond recovery growth, and the dynamics between those two, and how they handle interest rates is going to be a big determiner.
Yeah.
We're in interesting times right now, and once again, stick with quality stuff that's going to work long term. That's really it's getting through the rough patches, which we always have in the past.
Yep. So if you have any questions, please feel free to reach out to us. Otherwise, we'll talk to you in another month. Have a great one.
Have a good August.